So let's talk about something really strange that's been happening in the stock market. It's a story that seems to completely ignore the basic rules of supply and demand. And yeah, it's all about one company, AMC. But the questions this whole thing brings up, well, they really make you wonder about the entire system. We're talking about huge financial players, the ones who once bet billions that AMC would fail, who are now quietly, completely changing their tune. So what is really going on behind the scenes here?
To get our heads around this, let's just start with a simple question. What if the stock market you see on TV, with the scrolling ticker and the big bell, what if that wasn't the whole story? What if most of the trading, the real action, was actually happening somewhere else entirely, completely out of sight?
Because you know what? That hidden action is happening, and it's happening on a mind-blowing scale. On a recent trading day for AMC, an absolutely staggering 73% of all trades went down off-exchange in what they call dark pools. Just let that sink in for a second. Nearly 3 out of every 4 shares being bought and sold were totally invisible to the public. This right here is the first major clue in this whole mystery. And that leads us to the central puzzle, the big anomaly. We're seeing days with enormous trading volume. We're talking millions upon millions of shares changing hands, and yet the stock price, it barely moves. Now, normally, that kind of activity would send a stock's price on a wild roller coaster. But with AMC, it's often just flat. It really suggests that some powerful, unseen force is at work, actively holding the price down.
Okay, so that price suppression gets even weirder when you look at our second clue, the totally baffling behavior of the very institutions that, not too long ago, wanted this company to go bankrupt.
Let's just hop in a time machine back to 2020. The story on Wall Street was simple. AMC was a dinosaur, a dying movie theater chain that was toast. That narrative was practically gospel. But now, today, that entire story has done a complete 180. The same people are now talking about strong financials and a super bullish future. It is a stunning, jaw-dropping reversal.
And look, this isn't just them changing their words. Their actions have totally flipped too. Firms like Goldman Sachs, who were once heavily shorting the stock, which is just a fancy way of saying they were betting on its price to crash, have reportedly closed out those bets. And now they're going long, meaning they're buying up shares and call options, which are direct bets that the price is going to go up.
Which brings us to the biggest question of them all. If you've got everyday retail investors buying the stock, and now these big institutions are apparently buying it too, Basic Economics 101 says the price should be shooting for the moon. So why isn't it? Well, the answer, if you believe the theory we're digging into, is found in a hidden market that operates in the shadows.
All right, let's pull back that curtain and look at the actual mechanics that people believe are being used to keep this price pinned down. This is where things get really wild, and we start talking about so-called phantom or synthetic shares.
So first, where is this all happening? Dark pools. These are private stock exchanges totally hidden from the public eye. Now, they were originally created so that big institutions could trade massive blocks of stock without causing a panic. But when 73% of a stock's daily trades are happening there, you have to ask, are they still being used for their original purpose, or are they being used to hide the true price?
Next, we've got to talk about a seriously controversial and, by the way, illegal practice called naked shorting. See, normally, if you want to bet against the stock, you have to borrow a real share first. Naked shorting is when someone sells a short share that they haven't borrowed or even proven exists. In simple terms, they're selling something that isn't real.
And a result of all that naked shorting is the creation of these synthetic or phantom shares. These aren't real shares issued by the company. They're basically just IOUs floating around in a broker's computer system. The whole theory is that these phantom shares are being used to flood the market and just soak up all the real buying pressure from investors. So here's the absolute key to this whole thing. The theory claims that for every single legitimate buy order that comes in from a real investor, a fake synthetic share is sold against it inside a dark pool. So the buyer gets their share, but because it was instantly met with an equal sell order, the transaction has absolutely zero effect on the public stock price. It creates this perfect but totally artificial deadlock.
Now, for a system like this to even work, it needs one very important ingredient: cheap, easy money. Wall Street calls it liquidity. And from what we're seeing, it looks like that well of easy money might be starting to run dry. It's like a pressure cooker, and the heat is getting turned up.
Think about it. Trying to maintain a gigantic short position, especially one supposedly built on these phantom shares, has to be incredibly expensive. You need a constant river of cash to keep it going. The argument is that this easy money is just getting a lot harder to find, and that's putting an immense amount of strain on anyone betting against the stock. And those who follow this theory point to two big signs of this strain. First, the reverse repo market, which is a really important place for banks to get overnight cash, is reportedly shrinking. That signals there's just less cash available in the whole system. And second, as that money gets tighter, the cost and the risk of creating even more of these phantom shares just skyrocket.
And all this financial strain might be pushing some firms to take some pretty desperate measures. According to one analyst report, some of these financial players have allegedly sold or repledged, which means they reuse their own clients' assets as collateral to the tune of over $20 billion, all just to stay liquid.
So why is that such a big deal? Well, because analysts looking at this see it as a massive red flag. It suggests that some of these firms are so desperate for cash to cover their bets that they're now digging into client assets. And that's widely seen as a last resort move you only make when you've already burned through all of your safer, more traditional options.
So if this whole system is really under that much pressure, what's the breaking point? What could finally happen that causes this whole dynamic to just snap? Let's look at what could actually trigger a massive change.
So, how does this pressure cooker finally blow? The theory basically lays out a two-step process. It starts with legal action, which could then lead to a forced, mandatory day of reckoning in the market.
And this quote from the analysis really says it all. Lawsuits, like one being pursued by another company called Genus Group, could end up setting a huge legal precedent. If a court or a regulator comes out and officially confirms that massive naked shorting has been happening, it could force these firms to cover. And that means for every single fake synthetic share they created, they'd have to go out into the open market and buy a real one to replace it.
And that really brings us to the final thought here. This whole theory we've walked through today has been focused on AMC, but it opens up a much, much bigger question. If these off-exchange games and phantom shares can be used to manipulate one stock so dramatically, what does that really say about the fairness and the transparency of our entire market? That is the real question at the heart of this whole crazy anomaly.